You just got a house back from the banks after so many years, and now it's going back to the same banks once again. After working closely for over 2 years in real estate with all the 4B entities, which are the buyer, builder, broker, and banker, now I'd like to talk about how the banks control literally every aspect of real estate and how you, the buyer, were always on a loose end. Here I'm going to keep it in a very simple and easy language for your better understanding, so let's get it started. Here, I will take you through the cycle of 4 stages of houses for a buyer. Stage 1, the pricing, where I'll talk about who decides the price and how. Stage 2, the loan process. This is where they put you in debt for decades. Stage 3, the payment period, where the banks actually make the money while you pay your mortgages throughout the loan tenure. And the final stage, the stage 4, that is the resale, when you decide to upgrade a house after years, and how banks once again involve themselves in this even after you own that house. Let's start with the stage 1, that is the pricing. It all starts with a proposal from a developer who presents and pitches the construction project to the bank just like any other startup. The builder meets a number of banks and eventually finds a bank who's ready to put in his money at a certain interest rate. Ideally, the interest rate is around 10% of the overall sanctioned amount. Builders usually don't put their money at this stage of construction, and even if they do, then it is very nominal and less. Now, because the project is heavily funded by the banks, technically they are the primary owners of the project, and the initial rate, or let's say the raw price of those houses, are indirectly determined by the banks itself based on the market valuation. In point number 4, we'll get deeper into this part of market valuation. You'll see the timestamp somewhere around here. After this, then the builder does a top up over this raw price and comes up with the price at which he sells to the customer, that is you. This is done by adding labor charges, operational cost, marketing cost, profits, loan that is repaid to the banks, and eventually other form of taxes. In simple terms, making some returns on the overall investment by inflating the price. And many times the developer make changes in the overall pricing to attract customers, but the focus towards the bank's terms and conditions are rock solid. Stage 2, the loan process. As banks are the primary owners of the house that you're trying to buy, now the banks are equally involved alongside the developer to enroll you for buying the house, and they do it by loans. Ideally, the banks makes it a very easy entry towards housing loans for the customers over any other type of loan. Getting a house loan is very easy, and the rejection ratio for housing loans is far less compared to the other type of loans, for example like car loan, personal loan, or even business loans, because the houses guarantees the returns to the banks. Also, many banks create an easy entry towards housing loans by offering low down payments towards the house. Sometimes it can go as low as between 5 to 10% of the asked price. Many times there are pre-approved offers from the funding partners and other such banks for some customers based on their credit score, loan repayment records, and other such factors. To make it even more easier for the customers, they offer longer loan tenures. So, longer the period, more the payment, hence more money to the banks. Realize that the bank will always find a way to make you eligible for housing loans as long as you, as well as your family, is capable of repaying it in some form. Stage 3, the payment period. This is the time where the banks truly make money. The reason why housing loans are made easy for you buyers is because houses are hard assets, which are always in demand and can easily be seized and sold in case of a customer defaults or fails to make payment after multiple notices. And people enrolled in housing loans have a very less chance of becoming an NPA, that is called non-performing assets, for the banks. The day you start making payments towards the loans, the bank will start playing a safe game and start making money for themselves. 100% of your mortgage payment will go towards the capital interest for the first few years. If calculated, sometimes the overall amount towards this capital loan is almost equal to the loan amount. And only after the payment towards the capital loan is complete, your further payments are directed towards the actual loan amount, which is also known as the principal amount. And when you add up this capital interest along with the loan amount, the overall amount you end up paying is almost twice than what you borrowed. In simple terms, you just bought a house for the bank. The longer you commit to the loan payments, the longer the cash flow is for the banks. And the longer you take to complete the loan, the more interest you end up paying, hence more money to the same bank. That is the reason bank discourages paying off loan early. Many times you even get penalized for it. Stage 4: Reselling and market value. According to stats, 90% of the homeowners starts to look for another house after spending 12 to 14 years in their previous property because of the family expansion and many such similar reasons. And many of those buyers either sell that property or try to ask for another loan as loan against property by keeping the earlier property at stake. Now just think about it. You just got a house back from the banks after so many years, and now it's going back to the same banks once again. Nevertheless, as we mentioned market valuation earlier, now let's talk about it. In either case of selling or asking for another loan against it, the price of that piece of property is once again decided by the banks. They do a complete inspection of the property through the bank's agents, and based on that inspection, the valuation of that property is determined. And because of the credibility and heavy influence on the public, their calculation of the valuation is treated as the official figure and price. Because the same buyer and the seller will eventually go to these banks when the transfer of piece of property happens between them. This endless cycle is the reason that 93% of all real estate around the world are in debt to the banks. Just think about it. It was always the house that owned you, not the other way around. And who owned those homes? The banks. So that was a video on how banks control every aspect of real estate. Hope you find this video helpful and informative. So stay tuned for more of the content. Peace out.